home is generally most people's biggest life purchase and the largest financial asset that they'll ever own. And as you pay down the mortgage over time and the value hopefully increases, equity builds in the property, creating a sort of forced savings plan that can serve as a nest egg towards retirement. But it's also the single largest loan most people will ever take out. And because of that, it's also where many people end up paying the most interest over their lifetime, where with average home prices and mortgage rates where they've been over the past 5 years, we're talking about hundreds of thousands of dollars in interest payments alone. And now that interest rates are beginning to come down and many fixed income mortgages are coming up for renewal, this is the perfect time to really fully understand how your mortgage works, and more importantly, how you can pay it down faster to save tens or even hundreds of thousands of dollars. Every mortgage payment you make is made up of two parts, principal and interest. The principal is the amount that you originally borrowed to buy your home, whereas the interest is what the bank charges you for lending you that money to begin with. When your interest rate is higher, your monthly payment also increases, assuming the same amortization period. And here's the kicker, interest is known as front-loaded. That means in the early years of your mortgage, most of your payment is going towards interest rather than actually reducing the loan balance, unless you have a crazy low interest rate. And it's only as the years go by that the principal portion begins to grow while interest shrinks. By the way, the amortization period is the total length of your mortgage, typically 25 years here in Canada for a primary residence, though the maximum has recently been extended to 30 years in some cases. Keep in mind though, a longer amortization does lower your monthly payment, yes, but you end up paying much more interest over time. For example, on a $400,000 mortgage, assuming a 4% interest rate the entire time, you'd pay $233,000 in total interest over 25 years with $2,111 monthly payments versus $287,000 in total interest over 30 years with $1,909 monthly payments. In Canada, you can lock in your mortgage rate for terms of generally up to 5 years. And at the end of each term, you renew at that going rate, which could be lower or higher depending on what you had before. This is also when you can shop around with different lenders to get a better deal. In contrast, in the US, you can generally lock in a fixed rate mortgage for the entire life of the loan, commonly 15 or 30 years, meaning your interest rate and payments never change unless you choose to refinance. All right, let's look at an example using real numbers. The average sold price of a home in Canada, where I live, is about $668,000 right now. Though don't be shied off if you're in the US, the same concepts apply to you as well. Now, we'll assume a 20% down payment, which leaves a mortgage balance of roughly $534,400. At a 4% interest rate over 25 years, the standard amortization, your monthly payment would be around $2,815. If you simply made those minimum payments for the full 25 years, you'd end up paying about $311,800 in interest, on top of paying back your $534,400 loan. So a total purchase price of $900 and nearly $80,000 without taking into account other running costs of the property. And here's the impact of just a small rate change. If your interest rate was only 3.5% instead of 4%, your total interest paid over time would drop to around $277,500. That's a savings of over $34,000 from just a 0.5% difference in rate, which is why shopping around and negotiating matters so much. So how can you reduce those massive interest payments and get debt-free sooner? Well, at its core, the strategy is simple. Make extra payments towards your principal. For example, if your regular payment is $2,815 per month, adding even $500 extra per month could shave years off of your mortgage and save tens of thousands of dollars in interest. But you need to know your mortgage type and the prepayment rules. Fixed rate mortgages usually have stricter limits and higher breakage penalties, often allowing you to make lump sum payments of up to 10 to maybe 20% of the original mortgage amount each year without incurring a penalty. For example, my mortgage lender allows me to pay back 15% of my initial loan per year without incurring a penalty. Variable rate mortgages generally allow a bit more flexibility, where you can break the mortgage early and penalties are often capped at around 3 months of interest compared to those bigger penalties on fixed rate mortgages. And third, open mortgages let you pay down the balance in full at any time without a penalty, but typically they carry much higher interest rates during the loan. So the trick is knowing your lender's rules and using every prepayment privilege that you can if you are serious about clearing your mortgage debt. Let's now talk about 3 different strategies using our $534,000 mortgage example at 4% interest over 25 years. Starting with a baseline for this example, if you make only those regular payments of about $2,800 per month, you'll pay roughly, $311,800 in interest, and it will take the full 25 years 300 months to pay off the balance entirely. That is relatively straightforward to understand. Prepayment scenario 1 would be making, say, a $30,000 lump sum at year 5, assuming it's an open mortgage at that point after a 5-year fixed term. So in this case, by putting an extra $30,000 towards your principal at the end of the first 5-year term, you cut down both the balance and the interest. Your total interest drops to about $277,000, saving you over $34,000, and you shave nearly 2 years off of your mortgage. Scenario 2 would be to, for example, make an extra $250 per month payment towards the principal. In this scenario, your total interest falls to about $266,000, saving you the better part of $45,000. And even better, you'd pay off your mortgage in about 21.7 years instead of 25 years total. And of course, the higher the extra monthly payment within your tolerated yearly amount, the quicker you'll pay down your mortgage and be debt-free. And finally, scenario 3 would be switching to bi-weekly mortgage payments rather than the traditional monthly payment, where you end up making the equivalent of 1 extra monthly payment each year. So instead of 12 payments, you're making 13 payments, accelerating pay down of the mortgage. That small change reduces your total interest to, in this case, about $268,000, saving you 44 grand over the course of the loan as well. So the past 3 scenarios encompass the 3 main strategies that can be applied to pay down your mortgage quicker. But let's say you wanted to pay down your mortgage in 10 years. What would be the best strategy to deploy? Well, let's take a look. So in order to completely pay off a $534,000 mortgage in 10 years, which is the example we've been using in this video, here's what that could look like. You would need to make a monthly payment of about $5,400 versus the baseline $2,800 over 25 years, meaning an extra $2,595 per month of extra tax dollars applied to the principal. I know that sounds like a lot because it is, but depending on your household income, it's not impossible. That said, this represents an extra $31,100 per year, which may or may not be tolerated by your lender. That is up to you to figure out. What this means though is total interest paid of about $115,000 over 10 years compared to $312,000 if stretched out over 25 years. That's an interest savings of roughly $197,000, which is monumental and can massively increase the growth of your net worth once the mortgage is cleared and the capital can now be allocated to investments.
By the way, if you're interested in playing around with the numbers for your own mortgage as well as term and interest rate, I would highly recommend that you use an online calculator such as this one right here. I'm not associated with it in any way, shape, or form. I just think it works really well. So the way it works essentially is you put your information in here regarding the original loan amount, your original loan term, 25 years in this case, and the interest rate. I put 4% because because that's the example we've been using throughout this video. From there, you also put the remaining term. So let's say you're taking this into account, 22 years left and 7 months to pay off the rest of your mortgage. Now from here, we have 3 repayment options, either a payback altogether, a repayment with extra payments per month, per year, or a one-time, or bi-weekly repayments. So let's start with the first option to give you some context. If we click on payback altogether, it is going to calculate that the payoff amount would be $502,000. That would be making a lump sum directly on your mortgage. Probably not the option most people would go with though. From here, we have a repayment with extra payments, which is most likely going to be your best bet to pay off your mortgage quicker. So let's click on that, and let's say we're able to add an extra just $500 per month to the mortgage. Well, from here, clicking on calculate, we can see that we would pay off the entirety of the mortgage in 17 years and 8 months, considering that the remaining balance is $502,000, let's say, because we're already a couple of years into our first 25-year total term. So in this case, though, we would have an interest savings of $63,300 and shave off nearly 5 years for the entire payoff date of the mortgage. If you're a bit more aggressive with this, let's say $750, this really goes to show how much small payments over time make a big difference. For example, bumping that up to $750, we can see that now we're saving nearly 7 years, or paying it off 30% faster, and having a total interest saved of over $84,000. That is huge. And then finally, we have the bi-weekly repayment, that option where, as I was mentioning earlier, we have 13 payments instead of 12. If we click on that and click calculate, well, we can see that it is still going to shave off 11% for the total term, or just under 3 years, and $33,500 in savings. So highly recommend you use one of these online calculators to play around with your own numbers and potential scenarios.
At the end of the day though, there is no one-size-fits-all answer. The right strategy depends on your income, your interest rate, and how much flexibility your mortgage allows. However, the bottom line is clear. Any additional payments towards your principal will save you a lot of money, often tens of thousands of dollars, and help you pay off your home much faster. If you enjoyed this video, please consider leaving it a thumbs up and also subscribing to my channel. Also, if you'd like to support the channel, check out the links I have down below in this video's description and pinned comment to open up some brokerage accounts, as well as checking out my fully free stock market investing course over on Skillshare. Has over 3,000 students, and again, 100% free on a 1-month free trial. So thanks a lot for watching, and I'll see you in the next one.